Mr. Kush Bohra of kushbohra.com. Thank you for joining us on News9, Kush. Always a pleasure speaking to you. And till yesterday, the overall texture of the market was looking rather positive. Nifty was making higher highs, higher bottoms, and then we saw a 1% crash yesterday. In fact, even today, we have broken below the crucial support levels. What's your take on the markets now, sir?
Hi, first of a very good morning to you and all the viewers. Always a pleasure to be here. Well, storm in a teacup. That's what I would call the index movement at least. And for a very simple reason, if you look at the broad range on the index is 21,600, on the downside and 22,000 or maybe perhaps 22,100 on the upside. The index has seen a fair bit of volatility within that range. Now, the ideal way to play the market, or at least on the indices, would be to play this range. The closer you are to the support levels, perhaps a buy trade from there on, and once you are closer to the upper end of the range, book some profits. That's how I would read it. Also, a fair indication of this had come around because if you see India VIX, we've seen India VIX at an elevated level of 15, 16 for a while now. Earlier, one of the assumptions was that because of the events lined up, which was the Fed meet and then the budget, thereafter, coinciding, the VIX was elevated. The VIX did not cool off after that. So perhaps this is an indication of how the markets are perhaps going to behave in the coming times as well. On the near term, my view remains the same. This is still a buy on dips kind of a market. 21,600 to 21,500 is a good support zone, and on the upside, we're looking at 22,000 and 22,200 as the upper band.
All right, and Nifty Bank, we have been talking about Nifty Bank and how it has been a major laggard in the past many months, in fact, if you look at it. But the banking index in the last two sessions has taken support at its 200-day moving average, placed somewhere around the 44,900 mark. And we are very close to it, as we speak, Kush. If we do break those levels, what sort of a, correction, let's say in percentage term, can one expect?
So don't rule out another, a 2 to 3% kind of a downside on the Bank Nifty. One of the key support zones below the 200-day moving average that we're looking at is 44,400. This is the low that the index had made somewhere close to, I think late Jan. So I suppose that is one level that could be retested. Today, surprisingly, we are seeing the Bank Nifty a little higher. But part of that surprise is explained by the fact that the Bank Nifty had already gone into a bit of an oversold territory, at least on the PCR, if you see, and hence a bit of a support zone. The 200-day moving average also playing up. But I think if someone was to still play this trade, I think 44,400 would be a positional stop loss, and then on the way up, we're looking at 45,800 and 46,500 as the level. And as I said, this I'm looking at a broad range. So the texture isn't all that great yet. A lot of the FII selling can be attributed to the fact that the Bank Nifty being under pressure, because we know historically IT and banking have been the preferred sectors for the FIIs, and the ongoing selling will perhaps keep some pressure on the Bank Nifty intact.
All right, and talking about the texture of the market, the broader markets are seeing a lot of selling pressure this morning. Both indices are down 1.5 to 2% as we speak. And in the past 3 or 4 instances when we have seen a major correction in the small cap and the mid cap index, they have bounced back and they have clawed all those losses in a matter of couple of sessions. Is anything different now?
Not really. I think that could perhaps be the texture going forward as well, because a lot of these names were overheated. If you see, especially on the PSU side, I mean, a lot of these stocks had actually gone into overheated territory. Now, if I take a cue from, a similar, setup in the derivative stock, a lot of these stocks were knocking on the thresholds or the doors of, those strike prices from the call option side, which had a very high open interest. So, on the cash segment, there was the stocks that were heated on the RSI, and then on the derivative side, there were stocks which were close to the, high OI call basis. So correction was due, and also it's healthy. Also, I think a lot of traders and investors and your viewers will be feeling the pain today, not as much yesterday, because yesterday it was just the indices that were, hit and perhaps, cooling off, seeing a bit of a profit booking. Right. Today, even when the indices are flat to positive, a lot of these mid cap and the small cap names have come under pressure. But I think this could be short-lived. A round of profit booking, perhaps it could extend to a couple of days more, and then we could expect a similar rebound once these levels cool off.
Good morning, Kush. I'll drive your attention to Life Insurance Corporation of India, India's largest insurer, which declared their results yesterday. 49% rise in net profits, close to 5% rise in the premium income, which grew to 1.17 trillion in the last quarter compared to 1.11 trillion in the same quarter last year. Overall market share of the company remains at close to 60%, 58.9 to be precise. Solvency ratio, which is important for insurance companies' ability to meet long-term debt obligations, rose to 1.93% against 1.85%. Shares have jumped 20% in the last 5 days. Today they have been slightly choppy. I mean, they were up 4.02%, in the negative 0.75%. Right now they are in the positive 0.71%. What do you make of LIC? They have fluctuated from a low of 530 to a high of 1,175 in just 1 year. How does one approach this stock?
Buy on dips. That would be the broad strategy that we're suggesting. Incidentally, every network that I've been on, I've been asked this question. Thankfully for us, we had a buy call on LIC for a while, and 1100 was our eventual target. That's been hit. We will revise this close to about 1200, 1250 zones from a positional standpoint. But right now, a stock as big as LIC in terms of the market cap has actually run up quite sharply. And as I was mentioning a while ago, that a lot of these names are in the overbought territory. LIC also is a case in point. So from my perspective, it's not a bad idea to take some money off the table from this stock. Perhaps a good entry point here would be 1070, 1050 kind of levels. So buy on dip is the strategy that we have on LIC. Any kind of dip closer to 1050 is an entry point for me, and then we're gunning for 1200, 1250 kind of levels on the upside of our LIC.
All right, and I want to talk about Zomato also. Phenomenal numbers. Look, are you looking to revise price targets over there as well? Because the profit figure that has jumped up by somewhere around 280% on a quarter-on-quarter basis. Revenue jumps across segments was phenomenal on a quarter-on-quarter as well as year-on-year basis. In fact, many brokerages have also revised their price targets. Kush, what's your call?
165, that's the revised target that we're looking at on Zomato. Even during its a consolidation phase over the last month and a half, we maintained a very clear view that this is a consolidation phase only, and nothing changes structurally for the stock, at least from a technical standpoint. Because remember, the stock had actually seen quite a bit of a run up over the last year, gradual but a steady run up. After that, a bit of a consolidation is warranted, in fact even healthy. So I think that view sort of come to fruition, where 150 was our 150 was the revised target that we had. That's been achieved today. But I think there is still a lot of steam left in that. We are seeing the stock up on back of very good volumes. So I think the next level that we should look at for the stock is 165. Anyone who's holding this stock should continue to hold. A trailing stop loss here would be close to 135 kind of levels. And again, nothing's changed structurally. In fact, it's only gotten stronger. So we're looking at 165 kind of levels on the upside.
And Kush, the other company that posted their results yesterday were the makers of Ultratech Cement, Grasim Industries, the flagship company of Aditya Birla Group. Their profits jumped as much as 48% to 1,114 crores. Consolidated revenues came in at 31,965 crores, up almost 11.6% from the same quarter last year. When we look at the stock, today it is in the negative. Last 5 days it has been in the negative almost 4.17%. Last 1 month also it has just been partially in the positive 0.12%. Is it a time to get into this stock right now as it is close, basically touching lows at the moment?
So it depends on your perspective. I'm assuming this question comes from a more positional and investment kind of perspective. Then there is not too much of an issue. The stock's actually not gone anywhere if you see since December, but before that there was a good run up on this stock as well. And once again it is back to those support levels of 2000, 2050, where the stock has taken support multiple times and has rebounded. The only thing is that the stock is seeing supply pressure on the upside, and that could perhaps abate going forward. But as of now, given the kind of support zones that we've seen around 2000 and 2050 kind of zone, here it's a good idea to accumulate. Again, as I reiterate that this has to be a positional view. If that is the time horizon, 3 to 6 months, then for sure this is a good time to accumulate or enter into this stock. 2000 is where I would now place my stop loss. On the upside, we're looking at levels of 2120, and then once that is taken out, 2180 as the positional target. So yeah, the stock is in a bit of a consolidation mode. A good time to enter. Just have some patience with it, as it's actually just in a consolidation mode, from even if you look at it from a weekly and a monthly perspective.
Kush, thank you for joining us here on News 9. Hope to speak to you very soon, sir.